Okay, we're starting in on week 7. The week before we have our midterm, which will be next week. I will have a video next week covering the review and things that I would want you to know for the test. I'll kind of go through the review sheet and give you some pointers and some more, maybe some details on what to study for the exam. Remember, you could probably want to start this week maybe. The exam is proctored, as I mentioned in an email and I sent out to everyone. You are allowed 1 page of notes, front and back, so make sure you take advantage of that. That is on your proctor form as well, so you shouldn't have any problems there. So let's go ahead and start in on this week, the tax credits. This is probably, if not week 2, knowing how to file, this is probably the most important week, or one of the most important weeks, I think, because this is the one most taxpayers are the most eager about. They want to know how much credits they're going to get. This is the part that lowers your tax bill the most when you're filing a return. When you compare credits to adjustments, what we talked about just a couple weeks ago, adjustments were items that lower your income and therefore get you a little bit lower tax. Credits actually lower the tax dollar amount, dollar for dollar, instead of just your income. Therefore, it's quite a bit better item to take if you can take a credit. An adjustment would be an example when you get to subtract out your IRA deduction, or you get to subtract out student loan interest. Those were a couple items, or moving expenses. Some of the things we looked at in week 5. And I gave a couple examples here. If somebody had a $30,000 income before an adjustment or credit, and then they said, okay, here's a $5,000 adjustment and or credit, which one would you rather have? And I showed the example both ways. If you decided to take it as an adjustment, therefore that $30,000 came down to $25,000 taxable income, you look that up in the back of the book, and you're going to owe $28.46. Or you could take a $5,000 credit, therefore your taxable income is still $30,000, and you're going to pay tax on the full amount. So it's about $700, but not a little over $700, $750 or so over the $25,000 example. So you're saving $750 if you take the adjustment. But if you take the credit, you don't owe anything. In that the full amount, you took dollar for dollar for a credit, $3,500 minus the $5,000 credit, you don't owe anything in that example. So in this example here with the $5,000 adjustment, you could have saved $700. With this one, you're saving all of it. You don't pay any tax. And then as I mentioned here, most of the time credits are definitely better. Some of the biggies are the refundable credits, and the biggest one of them all is the earned income credit. If you're eligible for this, you know it. There's a 98% chance that you know it. For those that are lower income, we're going to talk about the income limits to still be qualified to receive earned income credit. Basically, earned income credit is free money. You don't have to have anything paid in, and you can still get earned income credit. The biggest thing, the biggest item to get earned income credit is you have to have earned income. So just living off Social Security or disability isn't going to get you any earned income credit. And typically, to get the big dollars, you're going to need to have kids. Kids help you get to your maximum earned income credit potential. The last two are also big in that there's this one's kind of like free money. If you don't have enough to take the regular child credit, which we'll talk about in a minute, then you can take this additional child tax credit. And that basically means if you qualified for this, then you didn't have enough taxable income. You didn't have enough tax liability to even use the regular child tax credit. Therefore, you get all of it back as a refund. The American Opportunity Credit is a big one. We're going to talk about that as well. These other ones are still good. They're just not as good in that if you don't owe anything in tax liability, your tax liability is already zero because when you subtracted out your standard deduction and your exemptions, it took you to zero. You didn't owe anything. If that's the case, then these credits aren't any use to you. But these credits are of use to those who still have a tax liability after those deductions, like standard deduction and personal exemptions. I would look at these also in the text, and I usually, like I always do, is I turn to the 1040, which is on page 2-3. But I want to turn to the back part of the 1040, so 2-4. So you start at the top on line 38 is your AGI. And then you get to subtract out your standard deduction or possibly your itemized deductions. And then you get to subtract out on line 42 your exemptions. Remember, that's $39.50 per individual you're claiming. So that could be a pretty high number if you're claiming, say, 5 people. Almost 4,000 times 5 would be nearly 20,000 off of your income. Then that's going to get you, when you subtract all those out, your taxable income, line 43. You find that in the back of the book. You determine how much tax you owe. And and that's where these credits on lines, starting on line 48 down through 54, where these credits are going to come into play. You can take off dollar for dollar that tax liability that you have and that you owe by reducing. We're going to talk about the retirement credit or the education credit or dependent care. But if you don't owe anything, because you come down and you got taxable income of 0, therefore your tax is 0, those credits aren't going to do you any good. Where those credits will do good is if you come down to the payment section, starting in line 64. That's where you're going to find these refundable credits. So you got the earned income credit, line 66, and then the additional child tax credit, American Opportunity Credit. Again, those were the big ones that I had mentioned. And that's where you're going to get, if you're going to get a big refund back, that's where the amounts are going to be. And I've seen that so far this year with our taxes that we're doing through the VITA program. A couple individuals getting over $8,000 in refund, one getting $10,000 based on, because they had 3 kids, and so therefore they got pretty much the maximum earned income credit and the additional child tax credit. Okay, so let's come down and we're going to first look at the couple of the refundable tax credits. Primarily the big one, I call this the biggie, the earned income credit. And generally you're going to have to be in the lower income levels to be eligible to get any earned income credit. It used to be only for 2 kids, but unless it gets renewed, which it may or may not, I don't know, but up through December 2017, you can get earned income credit, and it continually goes up and up to 3 kids. Now, if you have more than 3, you stop it at 3, and you don't get to claim anymore for the earned income credit to maximize out. But 3 is better than 2. You get a little bit more back. You'll see the most difference is between 1 and 2. But between 2 and 3 is a little bit higher. Your earned income is based on your AGI and even more importantly your earned income. And then we're going to look at a chart just to kind of see how the long way, how you determine what your earned income credit is, so you can have an idea in your head what income levels you need to be at to get the most earned income credit. So if somebody asks you, I have an income of this amount, of $40,000, do I qualify for earned income credit? You would kind of have an idea after looking at this chart whether they do or not. And it depends on how many kids they have, depends on their filing status. So there are different things that we'll need to know. So let's look at the table here on page 9-25. And it's at the top. And I'll explain how this table, it's not really the easiest thing to just look at and know what you're doing by any means. How much you're allowed for earned income credit. Let's look at a few of the numbers here. Go down to the second line. Let's skip the first one for a minute. For earned income up to $13,000. $13,000. You're allowed. You can have. Let's actually skip down one more. Let's talk about how much possibly you could have. If you have 3 or more kids, if you're in the right bracket, you could get up to $66,143 as free money back on your return, which is a huge boost. If you were only expecting maybe $500, and then all of a sudden you got bumped up to another $6,000. For joint filers, notice the phase out. So if you have, now let me go back up and show you where that 6143 came from. You go back up a line for earned income. If you have earned income and it starts there at that $13,650, you're eligible for the entire amount of earned income credit. If you take $13,650 times 45%, you get that 6143 number. So any income, earned income that you make below $13,650, if you have 3 or more kids, then you get to multiply that earned income by 45% to see how much in earned income credit you get. And then notice that number goes down if you have 1 kid. It goes down to you only get earned income credit up to $9,720, and you only get it at 34% instead of 45%. And then notice how much it really goes down if you have no kids. You only get 7.65% instead of 34% of your earned income, and that's only up to $6,480. So with no kids, the most you could possibly get, you see there, is $496. Okay, so now it says for joint filers, we go down halfway through the table, and let's go back up to 3 or more. That joint filers, it's telling us the phase out starts at $23,260. So if you make between the beginning $13,000 and $23,000, that's the prime sweet spot for income if you want the highest earned income credit. If you make in between those two, you're going to get the absolute most you could possibly get, that 6143. If you make below $13,000, you're not going to get quite as much. If you make above $23,000, then you start the phase out. And we're going to talk about the phase out and how that works in just a little bit. And notice if you're any other filing besides married filing joint, if you're head of household single, then you don't have nearly as much sweet spot area. You're between $13,650 and $17,830. And notice when you're fully maxed out for married filing joint with 3 kids at $52,000, then you no longer qualify for earned income credit. $46,997 if you're single or head of household. You're fully maxed out if you have 3 kids. All right, so let's go through a couple examples and show how this works. It's actually calculating it out. So we have a married couple here, $33,000 with 2 kids. What is their EIC? I'm going to go through one of these. You can go through the rest of them just to kind of practice and get a sense of if where somebody comes to you and they say they have $25,000 earned income, could they get the earned income credit? And you'd say sure. As long as you have at least 1 kid, then you're going to qualify for at least something. You won't get the full amount, but you'll get definitely a piece of it. So I go up here to my lecture answers, and I'm going to explain how I went about figuring this credit, because it's not the easiest to just look at it and know it. Okay, so we have a couple, 33,000, 2 kids. The first thing I want to start with is how much could they possibly get if they were in that sweet spot zone. And the possible amount there, it says maximum EIC in our book for 2 kids is $5,460. Now this couple is a little bit outside of the phase out. because they did make over the low end of the phase out of 23,260, but they're definitely not up to that 49,000 mark. So what we have to do, and it tells us the phase out percentage there in the chart is 21.06%. So what you have to do is you have to figure out, you have to get the difference between what you make and the bottom phase out number. So in this example, it's 97.40, that difference, and then multiply it by the percentage that they give us there. So when you take that, that's how much you're not allowed to take of that 5460 number, the max. So you start with the max, subtract out that 21% of the difference. Notice you get $2,051 that you're not allowed to take, leaving earned income credit of $34.09. Now let's just do a quick example. What if our income was at $52,427, which just happens to be the highest dollar amount? If this was the AGI number, or our earned income, if we took, instead of 33, and I'm going to pull up my calculator, you won't be able to see this, I know, but you can do this on yours as well. But if I did 52,427, so I'm replacing this 33,000 with this 52,427 number, which is the highest phase out for earned income is 3 or more kids. I took 52,427 minus the 23,260, and you'll notice that is the same. Let's try it one more time. 52,427 minus 23,260. You're going to get 29,167. If you take 29,167 times that 0.2106, well, that takes us. That takes us up to the 3. I'm sorry, that's the 3-1 amount. Maybe I shouldn't have done that. We should have looked at the AGI for 2 kids, because that's what we're working with. 49,186. Sorry about that. So let's do 49,186 as our income, and you'll see why that's the maximum number. 49,186 minus 23, still the same bottom number, 23,260 times that amount. I got 25,926 times by 0.2106, and I get the 5460. So we would have to subtract 5460 minus 5460, leaving us therefore with 0 earned income credit. So you can try those next ones and look at how I did it to determine, well, how much could we possibly get? Just for example, look at C. Look at C. C tells us we had head of household status, and our individual makes $15,000, and we had 1 kid. So if you have 1 kid, okay, you had 1 kid, the maximum amount you have to at least make $9,720 to get the full dollar amount. We definitely did that. We have 15,000, so we're over the 9. However, we don't quite reach the bottom phase out limit. The bottom phase out limit being 17,830. We're in that sweet spot between the 9,720 and the 17,000. Since we're in that zone, we get the full amount that's possibly allowed, the 3,305. And then you'll notice for D, the individual has 2 kids, but they don't have earned income of at least the maximum amount of $13,650. So therefore, we take what they do have, 10,000, times it by 40%, and that's simply what they get. They don't get the full 5460 because they didn't make up at least $13,650. Notice a couple criteria for an individual. They can still get earned income credit if they have no kids, but it's very limited, as you can see in the book. As I mentioned, it's only 7.65%, and your income, if you're a single or head of household, if you make over the top phase-out limit down there at the very bottom of the table, $14,590, you make over $14,000, you're not going to get any earned income credit. You also have to be in the prime working ages, so between 25 and less than 65. So therefore, if you're a typical college-age student, you don't qualify for earned income credit. You also don't qualify if you're claimed as a dependent. And I give you the top, you can get these off of your book anyway, but the top amount that you could possibly get for earned income credit and free money. This credit is highly abused, as I mentioned, so therefore those who do take it are subject to a better chance of an audit, but it's definitely worth the free money if you can take it. You shouldn't do it just because you're going to possibly get audited. Now I have a couple examples, and I just added these to my notes this year. And these were because of some real life examples that happened in just these past couple weeks. And these two individuals that came in, one of them was a couple, grandparents. They were almost back to back, and one overheard the other, and they thought maybe they would be eligible for some earned income credit like one of them was. And this kind of got to be a, how does this actually work in real life? And so this is as close as I can show you to a real life example without using actual names and showing you all their forms. But let's go through these because I thought these were pretty important. What I want us to do here is for the earned income credit, if to be able to claim the earned income credit, the child, you have to have a child basically, and it has to be your qualifying child. So just because you claim a child as a dependent isn't good enough. And that's one of the key rules that I needed to, that I probably should have listed here, and maybe I'll add in here to my notes, is the earned income credit is designed, is you must have a qualifying child. Must have a qualifying child on your return. So remember what it takes to be a qualifying child. It has to be your son or daughter or a descendant of one of those, so grandchild is also allowed. It can be a brother or sister or a descendant of those as well, as long as they are younger than you. So let's look at how that qualifying child kind of happens. What I wanted us to do in this example, and this is what I'll have, some of the questions I'll have on the exam as well, is I'll give you a scenario. And like what we did in Chapter 2, in Week 2, I want you to be able to tell me what is their best filing status, what is, how many exemptions can they claim, what's their filing status, are they allowed for child tax credit, and are they allowed for the earned income credit. So this taxpayer came in, and she has a live-in boyfriend. $15,000 she had in earned income. And she provides 100% support for her boyfriend, who didn't have much income, and her boyfriend's son. Of course, the son wouldn't have any income. And they both live with the taxpayer, who's the girlfriend. The boyfriend files the tax return, but he doesn't claim himself. He only files to get a refund, and he doesn't claim his kid. And we'll assume that the boyfriend has full custody, and the ex-spouse, or whoever the mother is of the child, is not claiming or doesn't have the option to claim the child either. Boyfriend is hoping that his girlfriend, the taxpayer, can claim the kid and any and all benefits that go along with it. And what would those benefits be? Okay, so we have to remember back, and you have to, this is where you'd want to do some review before, especially for the test, is remember back to what are the rules in claiming a dependent. Remember, you cannot claim somebody else's child if that individual has the requirement to file a tax return themselves. But this individual, when they only made $2,000 in gross income, they're not required to file due to their filing status. They aren't required to file. So even if he does, it's okay as long as you're only filing to get a refund and you're not filing because you have to. If that's the case, then that exception applies. So without the exception, somebody else, the girlfriend, could not claim the 6-year-old boy. However, with the exception that the dad doesn't, who has the ability to claim him, but doesn't because he doesn't have to file. Now, just because if the boyfriend did have to file and he chose not to claim him, it wouldn't matter. The girlfriend still couldn't claim the kid. So if the boyfriend has to file, he better just go ahead and claim the kid, because otherwise nobody gets to claim it. But if the boyfriend does not have to file and only files to get a refund, then the girlfriend has an opportunity to claim the child for a dependent exemption. But that's it. If we remember back to the rules, the girlfriend could not claim head of household, because to claim head of household, the person has to be a relative. She cannot claim the child tax credit because they must be related to you and must be your qualifying child. Same for the earned income credit. The earned income credit must be your qualifying child. And in this case, the kid is not a qualifying child of the girlfriend because it's not her child. The kid is just a regular dependent, same as the boyfriend. So all she could claim is the dependent exemption for both the boyfriend and the boyfriend's child. Thus, she could take off $7,900 off of her income, which is still good, but not nearly as good as she could take all of these guys along with it. So I had somebody come in this exact same situation. I think it was flipped, though. The boyfriend worked, the girlfriend didn't. And they overheard talking about other couples who could take all this, and they were a little upset that just because they weren't married yet, that they couldn't take head of household child tax credit, earned income credit. And I told them if they did get married the next year, then they could claim child tax credit because they would be married, and the child would then be part of the family. It would be a son of one of them, of the wife, and a stepson. A stepson is okay. Earned income credit would be allowed as well. So their refund could have went from $90 up to potentially $4,500, $5,500. So a big jump just by getting married and having the child being claimed. Let's look at the second one. A classic example that happens a lot, 3 generations living together. We've got the grandparents, the mom in between, maybe a 20, 30-year-old something, and then the mom has a child. And in this case, the grandma and grandpa had a relatively low income, but not that low for those who are close to retiring and maybe starting to live off Social Security. The mom, she was actually married at the end of last year, but was separated for most of the year and will not be filing a joint return. That's key. She only had $1,000 income, and then she had a daughter. I don't remember exactly how old the daughter was. I think she actually had a few kids, but it doesn't matter. Just with one, we're going to talk about with one. So mom doesn't need to file. She definitely didn't earn enough. She could have to get a refund, but I don't even think she had any money taken out. So the mom didn't file and didn't even need to. The kid and the mom lived with grandparents for over half the year, so 9 months, and they were supported by the grandparents. the separated spouse, the father, who they are now divorced, I found out. They got divorced in early 2015. The separated spouse, the ex-spouse, states that he will claim the 3-year-old child. What can the grandparents do, if anything? Are they allowed to claim him? Is the ex-spouse, the father, did he do the right decision in claiming him? Well, this happens all too often, and what's going to happen in this case is the return's going to get rejected when I try to e-file it. If the father had already sent in a tax return and claimed the kid, then the computer knows when you send it in, it'll say reject. It'll say rejected because that Social Security number for that child was already in use. So therefore, they wouldn't be able to claim the kid. However, they can claim them, and they just have to do kind of a battle with him through the IRS and be able to prove through the IRS that they are the ones that are allowed to claim him and not the father. That the IRS would then come down on the father and say, you got a refund of $3,000, you're going to have to pay us back almost all of that because you claimed earned income credit when you weren't allowed to. The father wasn't allowed to claim the kid because he didn't live with the kid for at least 6 months. He only lived with the kid for, at the most, 3. So that disqualified him from being able to claim the child for earned income credit and child tax credit purposes. So in this example, the grandparents can actually claim everything. They can claim the mom and the kid's dependent if they choose to. They can use the kid for the child tax credit because even though it's not their child, it's a child of their child's. So remember, you can do a child or the descendant of, and that is the case. And they could also claim earned income credit. So this couple's refund went from about $250 up to over $8,700 in this example, from where they thought, oh, I don't think I can claim them, and they came in here. And so instead of leaving with $250, I told them, no, you should probably claim these kids, and we talked about it, and sure enough, they can. So their refund went from $250 to $8,700, a huge difference. Now, they will probably have to go through the IRS to get that. They'll have to be able to prove that the kid lived with them and not with a father, but they said that would be no problem. Non-refundable tax credits. Now, this one's non-refundable in a sense, but it also is refundable for those with low enough income. You can get the additional child tax credit. There's different calculations you have to do. We're not going to get into that. But quite a few people, even if they can't take the child tax credit because their income was low enough and they didn't owe anything, but they can still get the additional child tax credit up to $1,000 per kid. So notice it's $1,000 per kid. The key rule here that I definitely want you to know and remember is the kid has to be 16 and under. My reasoning that I think they did this is because at the age of 17 and above, the kid can begin to take care of themselves financially. The kid does have the opportunity to begin working, and most 17 and above do have a part-time job to help support themselves. Notice there is a phase-out. You cannot take the child tax credit if you are, or not take it all, I should say, not take the most of it. You begin to be phased out if you had 110,000 AGI, married, 75,000 single, which I don't think is quite right. I always like to see the married one double the single. It's not the case here. And then notice how the phase out works. If you're over 110,000, even by $1, you get $50 taken off of your maximum child tax credit for that one kid. So if you were due 1,000 and you had 110,000 and $2 income, then you would only get $950. If you had 2 kids, you would get $1950. It's not $50 per kid, it's just $50 total. So in my little example here, example G, we have 3 kids and married filing joint. What is the amount of child tax credit? Notice that we don't hit the phase out, so that's fine. And we would also notice with the kids' ages, we're only allowed to take a credit for these two. 17-year-old, we're not allowed. So our credit for G would be the $2,000. And then for H, with our income going up to $115,100, we are over the 110 phase out by 6 units, as I like to call it, 6 units or 6 increments. Between 110 and 111 is 1, 111, 112 is 2, and then you actually have to count this between 115 and 116 as the 6th unit that we're over. So with the 2 kids, 6 units, so $50 6 times is how much we're not allowed to take. Again, that's not 50 per kid, that's just 50 total. So we'd be allowed to take $1,700 credit. The Child Independent Care Credit. On your tax software, and maybe I should bring this up, but I'll bring this up towards the end so you can see how this is going to look. You have to fill in who the daycare provider is with their address, and you also have to put in their EIN number. You have to put in how much money was paid to that care center, and then go down to Part 2 and fill in how much is allowed per that individual. So if you have more than one, you could put in more than one kid. Then you can calculate the Child Independent Care Credit. Notice you have to fill in 2 sections in the Tax Act software, and I'll talk about that, but just to get it in your head, fill out the top, you have to have the address and the name of the place with your EIN number. And then you also have to have the kid down below in Part 2 and how much per kid was paid for that place. Notice your expenses are allowed only if you are working or you are in school or looking for work. If you simply have child care because one parent works and the other parent is stay at home and cleans or does whatever homework they want to do, the home body, you wouldn't be allowed child tax credit because the one spouse isn't working, therefore they are deemed to be able to watch the kids. We'll go through, and I'll mention that better in a second. You don't get a credit for the entire amount that you pay in. The most that you can pay in is $30,000 per kid, up to 2 kids. So the most that you can qualify for expenses is $6,000. And then you'll want to turn to the very beginning of Chapter 9, page 9-4, to look at the percentages. Where is your gross income? And this will tell you how much of that child care expenses that you paid, up to $3,000 per kid, how much of it you can actually take as a deduction. So if you made $45,000, you could only take 20% of the $3,000 in expenses as a credit. So 20% of $3,000 would be $600. If you have money taken out through a flexible spending account and you use that money to pay for your child expenses, then you can't count it twice. There's no double dipping. You can't have it taken out of your check and not be counted as income and then take it as a credit as well. Here's the rules for child tax credit, how old they can be. They have to be 12 or younger, or incapable of self-care due to some form of disability. Who is allowed? It can be for any kind of daycare center, day camp, just not to a dependent. It can even be a payment to a relative, and that's fine. So you pay your mom and dad to watch your kids. As long as you don't claim your mom and dad as a dependent, that's allowed. Here's the couple things that are definitely not allowed. Notice these expenses include so that both taxpayer and spouse can work. If you're married, you've got to have all the information that I was talking about. The expenses, $3,000 and $6,000. If you have 2 kids, that's the most. So if you have 3 kids, you have to stop it at $6,000. And then this is key, especially for a couple of the homework problems. Your qualifying expenses must be below or equal to the lesser spouse's income. So that's why I said if you had a stay-at-home spouse who didn't earn anything, then below the equal or the lesser of the second spouse's income, well, if she didn't make anything, that's 0. So your qualified expenses would only be able to be 0. So you can take the lower of the $3,000 max if you paid over $3,000, or the lower spouse's income. The only exception is if the individual is a full-time student. If they're a full-time student, then they are deemed for this purpose only, not on the tax return, nowhere else, but for this purpose only, you're deemed to make $250 a month in earned income, or $500 a month if you have 2 kids. So therefore, you can go to school, and it still looks like you have earned income for this credit only. So if you went to school and you had 2 kids for 4 months, and you paid $6,000 in expenses, that you would be deemed to only take $2,000 because you only went to school for 4 months. 500 times 4. You would have earned income of $2,000. Even though you paid 6, you have to take the lesser of the other spouse's income. Okay, I think I do a decent job of explaining how I get the answers for these guys for I, J, and K. Let's keep moving on, because one of the last items that I really wanted to touch on was the education credit. And I've got about 5 to 10 minutes here left that I want to use before we cut off. Education can be, you can get free money up front in the form of Pell Grants, scholarships. And if you get Pell money up front or any kind of free money, but then you get it refunded back because you actually had more scholarship and grant money than you needed for tuition and books, and you get some of that money back to help live on. What a lot of people don't know, at least probably I would estimate 75 to 80% of even CPAs don't know, is that free money that you received as a refund to live on, that is taxable income and shows up on line 7 of the 1040 as taxable scholarship wages. So again, and I have a couple examples of this, but if you had a total tuition of $3,000 with books, and you got Pell Grant and scholarships worth $4,000, so Ivy Tech refunded you $1,000, that was free money that you never have to pay anybody back. That $1,000 will go on your 1040 on line 7 as taxable scholarship income. So many people don't know this. As you'll see here, and you can read through this, the 1098-T, I don't even look at it when we prepare taxes. I have all of the students print off their account activity balance, and then it shows me an itemized listing of how much money came in through Pell Grants, through scholarships, through loans, or just cash, regular cash payments, and how much was refunded. And by looking at all that, I can then tell how much should they have an income. Did they get more money refunded to them than they even needed? Or did they get money simply refunded because it was loan money that they took out student loans to pay for living expenses? If you took out student loans to simply pay for living expenses, then that's not taxable, because you will be paying that back, the student loans. The last item on this is if it's the other way. You actually have to pay money in for tuition and you don't get enough free money or any free money to pay your tuition. You have to pay some out of pocket and or through loans. Then you can take an educational credit, which is a big deal. and you get a lot of money back, possibly dollar for dollar, all of the money you spent in. Maybe more, I mean maybe less, maybe more, not more, but maybe less, because you are limited up to a certain amount. Notice my example here. You may want to write this out somehow so you can visualize it better in vertical format or however. So in this example here, the student took out quite a bit of money out of their some federal loan program, basically to help them live on, because they don't plan on working. They got some free money, $4,000 plus another $2,500 in Ivy Tech scholarship. Total for tuition, $3,500, their books, and they got a computer for school, which can all be counted as education expenses. And then Ivy Tech refunded them $7,200. And we could easily add this up to see how Ivy Tech got that. You get out your calculator. Again, I know you can't see mine, but get out your calculator and add up. The first thing you want to do is go down here to my, I think this will help you. But go ahead and add up all of the payments that were sent to Ivy Tech. So get out your calculator and you take the $6,000 that's paid to Ivy Tech, the student loans. It goes through Ivy Tech and then Ivy Tech disperses it out. Plus the $4,000 in Pell, plus the $2,500 in Ivy Tech scholarship. When you add all that up, as I have there in line 1, you get $12,500 payment. And then if you subtract out the refund, minus $7,200, all the money paid in minus what was refunded, that total then is going to tell you how much the schooling costs, school tuition, plus books, plus the any school equipment. And that's, so what you got for $5,300, if you would add up this whole line here, that does equal $5,300. But a lot of times these amounts are small and piddly, and it's hard to add them all up when you're looking at an itemized report. So it's easier just to add up, and this is what I have my tax preparers do. And this is what I'm going to have you do on the tax return that you're going to be preparing and for the exam, the midterm, is you're going to need to add up all of the payments that came in and then subtract out the refund to find, okay, this was the total schooling cost. So Ivy Tech, and the student had bills of $5,300 that were legitimate school bills. If they had free money over the $5,300 in school money, which they did here, we got a negative amount because the free money was more than the actual tuition costs with books and stuff. This amount is actually taxable and goes on line 7 of the 1040 as taxable scholarship. When I'm showing the education credit or the dependent care credit, I'll also try to bring this up and show you where that's at as you're filling out the 1040. So if your answer happens to be a positive number, so your free money was less than how much you actually paid in or what was due, then that's an amount that actually goes towards your educational credit that we'll talk about here next. So I made this little example to show you 3 different semesters and all the money that was brought in. Notice that the 1098T box, and I would go ahead and look at what a 1098T looks like, just to give you an example if you've never seen one. You could pull it up on your own student account. You can go into Campus Connect and pull it up. There's in that green box in the middle of Campus Connect, there's a 1098T option. Or you can look at page 9-14. With Ivy Tech, they only fill in box 2 usually and box 5, which just aren't enough. To me, it doesn't matter how much was billed. Billed is pointless because in tax purposes, it's all about how much was paid. You could bill $1 million, but if you only get paid $5,000, you can only show $5,000. And then scholarships and grants. Scholarships and grants are not recorded until after the semester starts. So usually for the spring semester, sometime early February. Therefore, Ivy Tech will bill you in December after you have already registered for your classes. So you could be billed in December, but it's not even for this year, it's for 2015. And then they'll just go down there and check box 7. But your scholarships don't include 2015 amounts. So in this case here, it looks like the individual had more billed than they did scholarships. But if you would go through and add up everything that happened just in 2014, you'll find that's not the case. So this is a prime example where the 1098-T is useless, and you have to go back and look at each semester by semester and add up the different itemized deductions. So go through this, look at my answers. I put out the answers here in L. Tell you how I got. What I did is that, I added up all of the money that was paid in each semester. I did it, you do it for the whole year and not necessarily just per semester. Subtract out the refunds, and then you get the total amount of tuition minus the free money. So basically, I just did this, and see how close you come to my answer key. The American Opportunity Credit. This is the big one for education purposes. If the Lifetime Learning Credit isn't nearly as good as this American Opportunity Credit. Some key things about this one. The payment has to be made in the year of the tax year. So even if it was for 2015 schooling, if you made the payment in December, then you can still count it in the 2014 year. And you can see who's allowed. Notice here, if you are a student and you paid your own expenses, but you're still counted as a dependent, let's say you paid in through a loan and the loan's in your name, it's very unfortunate for you because your parents would have to claim the credit. Because if you are a dependent, you cannot claim the American Opportunity Tax Credit. So your parents get the benefit of you paying the money, which is not a good deal. You can't take both the Lifetime and the American Opportunity Credit in the same year. And this is directly out of the book, almost word for word on page 9-8. And this is on a couple of your homework examples as well, in the multiple choice, and I think one of the other problems. If someone other than you or the parent pays for your bill and they pay it directly to the school, then that's counted as paid by the student. So you get to add that in to your American Opportunity Tax Credit, which is good. You can add that in as total tuition that you paid. Notice for the American Opportunity Credit, it includes your tuition, books, and equipment, which none of the other ones, the Lifetime Credit, nor the tuition and fees deduction, they do not count tuition, they do not count books and equipment. That's a biggie. This is the only one, American Opportunity Credit is the only one that allows equipment and books. So equipment, as long as you had you used the equipment that you bought for school purposes, and that was the reason you bought it, then you would be able to use that as a qualified expense. You're not allowed to use room and board, though. That's for the American Opportunity Credit, you're allowed to go your first 4 years, which is different than the Hope Credit. The Hope Credit was something that was before the American Opportunity Credit. American Opportunity Credit replaced the Hope Credit, and it's going to be around until December 2017, and I hope it gets extended. I think this would be one that definitely will. That's just mine. If not, the Hope Credit comes back, and it's not nearly as good as the American Opportunity Credit. You can only do 2 years with the Hope Credit. With this one, 4. Have to only go at least a half load. You're allowed to take 100%, dollar for dollar, for the first $2,000 you pay in qualified tuition, which is awesome. And then 25% of the next $2,000. So the most you can possibly take is $4,000 in expenses. Notice there is a phase out. If you make too much, if you make not enough, if you make very little amount of money, then you don't get as much back either. So it kind of goes both ways, but for sure the phase out here being for higher income earners. Notice that 40% of the credit is refundable, which is different than the whole credit. None of it was refundable. That means 40% means that if you were due back $1,000, and even though you don't have any tax liability, so instead of taking 0 for the credit, you can still take 40%, $400 of the $1,000 that you were due, just because you had no tax liability. So that would be a case where having a lower income could hurt you in this case, but you still get back 40%, which is way better than nothing. You're going to be doing all of this on Form 8863, and you'll definitely want to link to that form through Tax Act to do it. I'll let you calculate the credit because I want to finish this up. The lifetime learning credit, notice it's tuition and fees only, no books, no equipment, no nothing else, just tuition and fees, and it's also not as good in that it's not refundable. So if you have very little, if you have low income, it's not going to be any advantage to you. And you're only allowed 20% of the first $10,000 that you pay. So 20% when you pay $2,000, you get to take $400 off instead of paying $2,000 up here and getting to take $2,000 off, all of it. So $2,000 versus $400, you can see the big difference. So the lifetime learning credit is more geared towards those in the graduate programs or doctorate programs after your 4th year. And then I'll let you look at the retirement contributions. Again, you can read through that. Typically, that's only for the lower income. You can see the AGI limits on page 9-19. They're pretty low. They're pretty low. Okay, the last thing I want to do is pull up the Tax Act just to show you a couple items. Okay, I'm going to pull up, let's see. I'm not going to pull up this week's. I'll pull up last week's, and even though it doesn't show anything filled in, I'll go into the Masterson shoebox case. And I start with the 1040. I'm going to look at the child and dependent care credit first. So I want to scroll down to the credit section, the second half of the 1040. Go here to the child and dependent care. Link it. You're going to have to type in the company name. Link it. Company name, their identification number. You have to do their address, and there's of course the state. And I think I gave you all that stuff. And how much did you pay to the child care provider? You got to have all this filled in. Then you come down here, and which child are you doing it for? Say you paid $3,000 for this individual. So you have to put their information in up here and here. If you don't put it in both places, it will not calculate correctly how much child tax credit, dependent care credit should go. So again, that was linked. You scroll down on the 1040 to child and dependent care. Now let's go to the education credits, 8863. Link it. The first thing you have to do is click that yes, this is a student. On this form, click who it is that you're doing. If you don't put their name and if you don't click on the right person, if you don't click on any of them, it won't give you the credit. Answer all of these questions, and of course this one's going to be important. How many years have they gone to school? If it's between 0 and 3, then they're still allowed. And then all of these boxes should be checked when you're done with all of these. And the biggie meaning that was American Opportunity Credit. and then start answering some of these questions. How much in free money did you get, scholarships? How much in tuition and fees? And even though it says it on the 1098-T, don't put the real amount that says on 1098-T. Put what it really was when you added it up and did it my way. The last thing I want to show you is if your free money performs your what it was actually due. And I told you it's going to go on your line 7. So you need to go here and then scroll down until we find the student information. And again, you're going to fill out this same sheet, but when you fill it out, the scholarship amount will be more than actual tuition, and it will show up there on line 7, $1,000 or $2,000 or however much it was more. So when you go to print it, and I'll go ahead and pull up my one for week 7, this week's one, just to show you what it looks like. I go to reports. If I were just to look at it as a PDF, I can't remember off the top of my head how you do that, but that's all right. I could print it as a PDF if I wanted to print this form and I wanted to preview it. Notice right here it's showing scholarship income of $1,000. It's not going to actually show you that when you're in the program, but it does show you if you were going to print it out that you do have that $1,000 scholarship there. So again, if I was back here on line 7, it doesn't show me that in the 45,000, but it is there when I go to look at the print amount, the preview. Out of that 45,000, 1,000 of it is scholarship. The W-2s were only 44. Okay, I'm going to end that here. Next week we're going to review for the exam. Make sure you called ahead and made an appointment. Any other questions, please email me and or email me your assignments, and I'll be glad to look through those. After anything else, I think that's it for this week.